My name is Alex Buriak, and I'm the Senior VP here at Jet Lending. Today, we're going to go over another episode of How Hard Money Works. This episode will focus on rental real estate and refinancing with asset-based long-term financing called non-QM financing, or non-qualified mortgage financing. Feel free to tune into our other How Hard Money Works episode to go over in detail about closing with asset-based lending. So let's begin. So let's say we have a property that we've purchased and we're going to repair it for purposes of rental. So let's say we bought it for $130,000. Let's say the after repaired value is $200,000. Let's say we're going to put 20 into this deal, and let's say the property taxes are $6,000. Let's say we don't have any HOAs or anything like that right now, and we hold the property repairs in escrow. Let's put this at 3% origination at 11.9% interest-only payments without early payoff. So in 3 days from clear to close, from title and appraisal report in, we're going to close this property, and the borrower would bring about $17,455 because we're lending 70% of the after repaired value, which is $140,000. We're going to take $20,000 out of that to hold in escrow for repairs. So we're going to put that $20,000 there. So we're going to close with $120,000. You're buying it for $130,000. You're coming out of pocket $10,000 plus closing costs. And again, check out How Hard Money Works on the first tutorial about how to come $0 out of pocket for 100% financing. So let's say this deal works this way. $130,000 purchase price, $20,000 in repairs, $200,000 ARV value, and you're going to rent it. The next thing we're going to look at is your rental calculations. So remember, this is going to be non-QM loans, non-qualified mortgage. So the rates are going to be a little bit higher, but they're going to be way easier to do because they're based off the asset of the property, not your income. So it's still based off the property. So they're not quite bank rates, but there's still a way to get really good volume and getting those rental real estate packages together as you buy inventory over the years. So let's say this is a single family house. Let's say it's, there's one unit. For today's purposes, it's not rented. This is going to be a refinance. Let's say you're going to project 12-month leases. This is not like a vacation rental or anything like that. A good side note on vacation rentals. Most of the lines for non-QM vacation rentals are still going to use rental rates of the 12-month leases in the area because vacation rentals have a higher spread of rental rates. So just be prepared that the lines are going to use normal rental rates in the area, not all the time your Airbnb and VRBO type rental rates. Okay, this property, let's say there's no flood insurance needed, there's no association dues. Your lien is if you bought this property in the past from asset-based lenders like Jet Lending, or you had private money, whatever you have to pay back. Okay, so that's the $140,000 from the other calculation. Vacancy and maintenance. Vacancy and maintenance is subjective to your business plan. On average, people use anywhere from 20 to 28%. I haven't really seen anybody use 30, but I'm sure somebody does. I want you to calculate this so you can see your all-in numbers to see if this is the type of property that is going to get the return that you're trying to get. So let's say 20% for our purposes here. Let's say that the projected rent in the area is $1,800 a month. On this estimate, let's say we're doing 70% loan to value on the refinance. Let's say your rate's at 6.5%. Let's say this is a 30-year fixed term. Okay? Let's say for just argument purposes, there's only a 1% appreciation rate in the area. And you're buying this on a projected 10 cap, but this is mostly for multifamily. This is how you do the income approach when you can't find values. Cap rate is very subjective to the area, okay? But we're just, for arguments purposes, we're just going to use this so you can see the income approach calculation. So as we're seeing this, we see that it's a ARV and sales approach. Let's say the income approach for $1,800 is $172,800 with a 1% appreciation. We're at a 6.5% interest rate on a 30-year fix at 70% loan to value. So as you see the calculations here, you're at a 1.23% DSCR, which stands for Debt Service Coverage Ratio. What that means is that, let's say your principal, your interest, your taxes, your insurance, and any association dues, that's your mortgage. Okay? What that is saying is that your rent divided by that is 1.23. So your rent covers that mortgage plus some. All right? Non-QM lines that we have can go anywhere from 1.0 to 1.3% depending on what you're looking for in rates and things like that. So that's why we do these calculations. So when somebody comes to us and says, hey, I think I'm going to buy this rental property, we'll say, okay, well, tell me about your business plan. Is this something that you want to buy? Don't get me wrong. If it's something that you're strongly about, we'll still close on it, but we want you to be aware we're behind you like 100% to make sure that you keep buying real estate, because we make money when you buy real estate. We make money when you're successful, not when you leave the business. So we want to make sure that you are getting what you're projecting so you can continue to buy real estate, because we're all trying to just grow our wealth. So with this deal here, you're seeing, okay, it's a 1.23, pretty safe rental deal. If this appreciated for 1%, over the next 30 years, your estimated profit on this property with cash flow and appreciation and things like that, because appreciation is the key to rental real estate, you're projected to make $356,000 on this property. If you had a 2% appreciation rate in the area, you're at 416. A 3% appreciation rate, you're at a 476. Now you're getting why people keep saying buy as many rental for properties as you can, pay the note down over the years, and now you have all this spread to either cash out and buy more, or bigger things, or you sell it and you get a big chunk of money, or you just pay them down and the cash flow increases over the years. So that's why we do these calculations, so people can see, hey, this meets my business plan. I'm totally going to close 3 days from clear to close from title and appraisal report in, because I can see how much money I'm projected off of these evaluations. Here's some other things that you should consider. So let's say that you're at a 75% loan to value. Everyone's like, oh, I want to take out more money. I want to take out more money. Look at your DSCR. It's gone down. The more money that you get lent, the bigger your interest payment, or your not interest payment, the bigger your monthly payment would be for something like this, because you're still paying the note down. It's not an interest-only payment. So now that you've been lent more money, your DSCR goes down. The less money you take for rental real estate, the better your DSCR is. Usually the better your rate is. That's why you'll see people pay their rate down on rental real estate. They'll put a point or two down. Let's say they're at a 7.5, and you're like, hey Alex, I want to pay 2 points down. I only want to put 5.5% for 30 years. Some people will actually pay that rate down, so their payments are down, so their cash flow is up, but their first year return on investment is lower because they put more money into it. It's all about strategy on how you want this to work. Long-term financing is way more complex than short-term financing. That's why we walk you through a lot of this stuff to make sure you're still doing what you're prepared that you were going to do. So let us know how we can help. Let us walk through your business plan and see how we can make it simple and how we can make it effective for what you're trying to do and increase your wealth. Again, this is Alex Buriak, Senior Vice President here at Jet Lending. We'll talk again.